The standing read on Alphabet has been stable for 2 years, a mature platform with incremental AI upside layered on top. Search dominance, YouTube cash flow, cloud growing but subscale. The $84.75 billion equity raise that priced on June 2 does not fit that frame. This is one of the largest equity capital raises in the history of publicly traded technology companies. It was announced at $80 billion on June 1. Within hours of book-building opening, institutional demand overwhelmed the original terms. It was upsized to $84.75 billion by June 2. That demand signal is the first thing worth sitting with. Pension funds, sovereign wealth funds, and long-only technology mandates did not hesitate. They did not wait for a lower price. They pushed the deal higher. The structure matters too, and it is worth one sentence of grounding before moving on. Alphabet issued mandatory convertible preferred stock, not common equity. That means dilution is deferred, not eliminated. But it also means buyers accepted a coupon plus upside participation rather than demanding a discount to the common. The fact that institutional buyers accepted preferred terms at this scale is a confidence signal embedded in the instrument itself. Now here's the tension the market has not resolved. Alphabet CFO Anat Ashkenazi stated explicitly that the constraint on AI service delivery is no longer algorithmic, it is physical. Data center construction timelines, power procurement, and custom chip tape-out schedules are the binding variables. That is a demand-confirmed supply gap. Alphabet cannot serve the customers it already has. But the articles also surface the alternative read, and it changes the risk profile entirely. The $80 billion figure was set by working backward from a 3-year infrastructure build-out target, not from a specific revenue projection, not from a backlog of signed contracts. That distinction is where the standing read breaks. If this raise is demand-driven, it is self-funding within a known revenue window. The capacity Alphabet is building will be absorbed by customers already waiting. The multiple expansion case follows naturally. If this raise is supply-side pre-funding, capacity Alphabet expects to fill rather than capacity it has already sold, the risk profile is different. The proceeds fund construction that will come online in 2027 and 2028. And by that time, Microsoft, Amazon, and Meta will also have reached full operation on their own simultaneous build-outs. The hidden assumption the bullish read requires is that Alphabet's demand is observed, not projected. Ashkenazi's language supports it. Outpaced current computing capacity is present tense. But the raise's sizing methodology, working backward from a 3-year target, is forward-looking, not backward-confirming. Both readings are simultaneously priced by different participant groups. That is not ambiguity to be resolved quickly. That is the core question a holder of GOOG must answer right now.
The Berkshire Hathaway anchor is the most underanalyzed element of this transaction. Greg Abel became CEO of Berkshire at the beginning of this year. Within 6 months, he has committed $10 billion to a single technology equity transaction. That is not a rotation. That is a declaration. Warren Buffett spent decades explaining why he avoided technology companies: capital intensity, competitive moat erosion, rapid obsolescence. His framework demanded capital-light businesses with durable pricing power. Abel has now placed $10 billion into the most capital-intensive bet in Alphabet's history. The contrast is not subtle. The first order read is straightforward. Berkshire is validating Alphabet's AI infrastructure thesis. A $10 billion private placement anchor by the world's most recognized value investor signals that the demand story is credible at institutional scale. It also served a commercial function. Berkshire's participation gave other institutional buyers confidence to push the deal above $80 billion. But the second order read is where the interesting tension lives, and this is the point most coverage has missed. Warren Buffett's best investments shared a common characteristic. They were businesses that looked like growth stories on the surface, but were actually utility-grade assets underneath. Coca-Cola, American Express, Apple, which Buffett described not as a technology company, but as a consumer products company with extraordinary retention. If Abel is applying that same lens to Alphabet, the implication is not bullish in the conventional growth multiple sense. It is bullish in a different register. Alphabet's AI infrastructure is becoming utility infrastructure, necessary, durable, priced on cash flow visibility rather than revenue growth rate. That reframing carries a multiple implication that cuts both ways. Utility-grade assets command certainty premiums. They do not command the 25 to 30 times forward earnings multiples that growth technology companies carry. If Berkshire's $10 billion is a utility re-rating signal embedded inside a growth stock transaction, then the deal that looks like institutional validation of the bull case may simultaneously be signaling that the multiple compression case is the long-run destination. The articles note that Berkshire invested $16.8 billion within 2 days across its recent moves. Abel is not cautious, he is moving with conviction. But the framework he is applying, capital allocation toward durable infrastructure, may be more Buffett than it appears on the surface. The buried assumption in the bullish read on Berkshire's entry is that Abel is paying a growth multiple for a growth asset. The alternative, that he is paying a growth multiple for what he believes will re-rate to a utility multiple, is not the same trade, and it is not a trade that is kind to holders who are long Google on the growth thesis. Alphabet's capital expenditure guidance for 2026 already stood at $75 billion before this raise. The company is now funding more than 2 years of its own stated capex target in a single transaction. That is not how growth companies fund themselves. That is how infrastructure companies fund themselves. And infrastructure companies trade differently.
The third layer of this analysis requires holding the demand-confirmed read and the supply-side read simultaneously, because the 2027-2028 window is where they resolve, and that resolution point is closer than most holders' current time horizons. Here is the concrete setup. Alphabet's new capacity from this raise comes online in 2027 and 2028. Microsoft's Azure expansion, funded through its OpenAI partnership and its own capital program, reaches full operation on roughly the same timeline. Amazon Web Services infrastructure build-out follows a parallel schedule. Meta is building AI data centers inside giant fabric tents to cut construction time roughly in half, a deliberate acceleration toward the same 2027 window. 4 of the world's largest AI infrastructure providers are reaching simultaneous capacity expansion at the same moment. The articles surface this directly. The risk is that Alphabet's capacity expansion will face price compression by the time it comes online in 2027 and 2028, as competing data centers from Microsoft, Amazon, and Meta reach full operation simultaneously. This is not a theoretical risk, it is a structural feature of the current investment cycle. Every major hyperscaler has publicly committed to a 2026-2028 build-out. None of them have modeled the pricing environment assuming their competitors hit their timelines too. The Microsoft dynamic adds a specific transmission path worth naming. Microsoft Build 2026 unveiled 7 in-house AI models, led by MAI Thinking One. Microsoft's AI chief described the company as set free from OpenAI, free to develop and sell frontier AI capability without routing compute spend through OpenAI's OpenAI. MAI Thinking One is available through Azure AI Foundry beginning June 2nd, at a price point analysts expect to undercut GPT-4o by 20 to 30% on comparable reasoning benchmarks. If Microsoft can deliver frontier reasoning capability at a 20 to 30% discount to the current market clearing price, the price compression in AI inference does not wait until 2028. It begins now in the enterprise market, as Microsoft converts its architectural independence into a pricing weapon. That matters for Alphabet's raise because the $84.75 billion in proceeds is being deployed against a revenue assumption. If inference pricing compresses 20 to 30% over the next 18 months, the revenue per unit of capacity that Alphabet's new data centers generate will be lower than the revenue per unit assumption embedded in the raise's sizing. The $80 billion figure was set by working backward from a 3-year infrastructure build-out target. If the pricing environment changes, the math changes. Now here is where the analysis lands, not as a forecast, but as a leaning. The demand-confirmed read, Ashkenazi's statement that the constraint is physical, not algorithmic, is the stronger near-term signal. Alphabet is not building ahead of demand. It has stated explicitly that demand has already outpaced its current capacity. That is a present-tense constraint, not a projection. But the 2027-2028 simultaneous capacity collision is a structural risk that the current multiple does not fully price. A holder whose time horizon is 12 to 18 months is likely operating within a favorable window. A holder whose thesis depends on Alphabet maintaining its current AI infrastructure pricing power through 2028 is holding a position that the competitive build schedule makes arithmetically fragile. The confirmation signal to watch is Alphabet's fiscal Q3 2026. That is when early data center utilization rates for the new capacity will begin to surface. If utilization comes in above 85% on newly commissioned capacity, the demand-confirmed rate is holding. If utilization tracks below 70% while Microsoft is simultaneously discounting inference pricing, the capacity trap read begins to gain traction. The $84.75 billion raise was the anomaly. The utilization rate will be the answer, and that answer arrives before the year is out. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.